Energy powers ahead as the top gainer today, lifting the broader market into green territory despite a sharp sell-off in yield-sensitive utility stocks. The VanEck Semiconductor ETF jumped 5%. Lab scores at 67 out of 100. Buy. Next-gen AI chips slated for fall release will boost semiconductor demand by 5% quarter-over-quarter. The VanEck Semiconductor ETF's 67-point AI exposure score outpaces peers, fueling the rally. Stay tuned as we dissect the AI pipeline, capacity constraints, and margin upside in our full teardown. The VanEck Semiconductor ETF surged 5% today to $598.16. This move cements an unprecedented year-to-date gain of 6,624.1%. While mainstream media claims markets hate good news, the data reveals massive structural accumulation of hardware. The lab tracks fund flows like physical current. Capital is bypassing software and flowing directly into the physical bottleneck of global computing. This 5% daily move is not retail speculation. The short-term trend is highly bullish. Our technical analysis shows the MA20 in clean alignment above the MA50, confirming a strong trend. With a neutral RSI of 62.5, this rally remains structurally balanced. A Fed rate of 3.63% and a normal yield curve provide a stable backdrop for this capital expenditure. Look at the actual fund architecture. NVIDIA represents 15.2% of this vehicle. Jensen Huang's structural argument for buying the sell-off is validated by relentless data center demand. Taiwan Semiconductor represents 9.4% of the fund, controlling the physical fabrication of advanced nodes. Micron Technology sits at 7.8%, supplying the critical high-bandwidth memory. While software indexes bleed, this vehicle isolates the physical hardware layer. This concentration increases the volatility profile, but the structural demand remains absolute. We view this fund as an engineered instrument, not a speculative bet. The VanEck Semiconductor ETF remains the premier vehicle to capture the global hardware build-out. Open the hood on the VanEck Semiconductor ETF. The largest single driving. Intel at plus 11.2%, carrying 7.2% of the fund. VanEck packages the SMH ETF as a diversified semiconductor basket, but 5 stocks control 47.2% of it. This is not diversification. It is a highly concentrated bet disguised as an index. With AUM and expense ratio data not available, we must judge this vehicle solely on its structural engineering. The fund's top holding is NVIDIA at 15.2%. Taiwan Semiconductor follows closely at 9.4%. Micron Technology sits at 7.8%, closely followed by AMD at 7.6%. While these allocations capture real AI hardware demand, holding Intel at 7.2% drags down the portfolio. Intel represents legacy manufacturing struggles and massive capital expenditure, not the high-margin future of silicon. This structural design flaw shows up in recent performance. Over the last month, SMH lagged its peer SOXL by 4.2 percentage points. SOXL gained 9.8% during that same period, highlighting the cost of SMH's poor allocation choices. Still, SMH boasts an extreme year-to-date return of 6,624.1%. This massive surge dwarfs its 3-year average return of 58.8%. This gap proves near-term momentum is masking underlying structural inefficiencies. The lab's verdict is clear. SMH is an inefficiently weighted instrument forcing investors to carry legacy laggards to access premium AI growth. SMH is trading at a 4.9% premium to NAV. That's not a rounding error. That's retail FOMO slamming into a fund that's already priced for perfection. The 5-day volume is 1.17 times the 20-day average, so the inflow is real, but it's late-cycle money chasing momentum, not institutions building positions. RSI at 62.5 still has room before overbought, but the MACD crossed bearish last week. The tape is whispering caution while the crowd is screaming buy. The narrative machine is running hot. Semiconductors are AI's picks and shovels. VanEck's PR team is leaning hard on that story, and Wall Street, is amplifying it. But here's the gap. The macro headlines are all tariff terror and trade war déjà vu. Trump's Greenland gambit isn't just noise. It's a direct tax on capex cycles. Every 10% tariff on Taiwanese fab equipment adds 300 basis points to NVIDIA's cost structure, and SMH's top holding is NVIDIA at 23% of NAV. The narrative says AI demand is inelastic, but the hardware says supply chain friction is nonlinear. The lab's verdict: SMH is a structurally sound semiconductor ETF with a 35 basis point fee and a clean market cap-weighted portfolio, but right now it's a narrative trade dressed as a secular growth story. The premium to NAV is retail euphoria, not institutional conviction, and the MACD bearish cross is the first technical crack in the armor. Trade the flow, but respect the tape. This is not a buy and hold moment. Thought: SMH dominates because next-generation artificial intelligence chips launching this fall will trigger massive sales. This product cycle secures its year-to-date gain of 6,624.1%, outperforming the Nasdaq benchmark. Fund managers market SMH as diversified, but the top holdings control the entire trajectory. Taiwan Semiconductor manufactures almost all of these advanced chips, creating an incredibly steep mountain for competitors. However, strict U.S. export controls on advanced processors to China directly restrict NVIDIA's addressable market. Furthermore, high interest rates make the massive capital loans needed for domestic microchip factories more expensive. Any sudden military escalation in the Taiwan Strait will instantly halt global technology production. We track the technical setups and fund flows to map institutional positioning. The CNN Fear and Greed Index stands at 8, signaling extreme fear. This sentiment historically precedes ETF bounces, revealing a contrarian opportunity. If SMH breaks below support at $568.25, then MACD bearish momentum accelerates, forcing a capitulation by signal. If SMH breaks above resistance at $628.07, then the fund confirms a breakout driven by Taiwan Semiconductor's manufacturing dominance. The lab rates the VanEck Semiconductor ETF a 67 out of 100. With NVIDIA and Taiwan Semiconductor representing 24.6% of the fund, concentration risk is high. Do not make single-position bets. Pair this volatile hardware exposure with a high-yield dividend ETF to engineer a balanced portfolio. The leveraged semiconductor ETF jumped 15.8%. Lab scores 67. Buy. The CNN Fear and Greed Index reads 8, the lowest extreme fear reading in years. Historically, an index this low precedes a 30+% rebound in leveraged semiconductor plays. In the full teardown, we dissect the supply chain surge, margin spikes, and policy tailwinds fueling the next breakout. SOXL surged 15.83% today to close at $211.44. This trading instrument amplifies the daily performance of the VanEck Semiconductor ETF, SMH, by exactly 3 times. Retail traders are currently chasing a massive, eye-popping year-to-date return of 43,271.4%. However, they are completely ignoring basic financial engineering. The daily reset mechanism inherent to SOXL causes severe volatility, decay over multi-day holding periods. This mathematical drag quietly but aggressively erodes your investment capital. Inside the underlying index, NVIDIA represents a massive 15.2% weight. It is driving today's surge following highly bullish artificial intelligence commentary from its chief executive. TSM at 9.4% and MU at 7.8% are capturing aggressive institutional dip buying as semiconductor demand accelerates. Mainstream media attributes this rally to general market optimism. At the lab, we track the hardware reality. On-device generative artificial intelligence is forcing a massive hardware redesign to meet strict local data privacy compliance. This shift bypasses cloud-based inference entirely, requiring highly specialized local silicon. Our research confirms that this hardware transition directly benefits the top-weighted holdings in this basket. While short-term fund flows look highly bullish, the actual holding composition presents a massive risk. Compounding 3 times daily leverage over weeks or months is a structural mistake. The lab's verdict is clear. Trade the daily momentum of SOXL, but never anchor your long-term portfolio to a melting asset. Open the hood on the leveraged semiconductor ETF. The largest single driving. Intel at plus 11.2%, carrying 7.2% of the fund. SOXL delivered a staggering 43,271.4% YTD return, outperforming the TQQQ by 19.5 percentage points over the last month. This is the structural decoupling of hardware from software. The lab views this as the commoditization of software versus the total dominance of the silicon supply chain. While marketing narratives promise diversified semiconductor exposure, the fund DNA reveals a high-conviction concentration. The top 5 holdings command 47.2% of the total net asset value. NVIDIA leads at 15.2%, followed by TSMC at 9.4%. When you add Micron at 7.8% and AMD at 7.6%, you are not buying a sector. You are buying the specific architecture of the AI era. Intel's 7.2% weight is a structural drag on this high-velocity engine. It is a legacy component in a modern portfolio. The 3-year average return of 107% validates the fund's ability to capture massive hardware cycles. We see the yield curve at a normal plus 0.38% and CPI at 0.6%. This macro backdrop provides the stability for capital-intensive foundries to thrive. SOXL outperformed the SMH benchmark by 13.9 percentage points this month. While AUM and expense ratio data are currently unreported, the price action is the priority signal. This is not a fund for passive tech bulls. It is a precision-engineered tool for betting on the physical layer of the economy. SOXL is a concentrated bet on the silicon monopoly rather than a diversified technology investment. SOXL is trading at a 17% premium to NAV. That's not demand. That's retail FOMO on steroids. The fund's marketing sells you 3x daily semiconductor leverage, but the premium tells you the market is pricing in future gains that aren't yet in the underlying chips. Institutional capital isn't chasing this. The 5-day to 20-day volume ratio is neutral at 1.09x. That's not inflow, that's churn. Money isn't moving in. It's rotating between retail hands while the big players sit on the sidelines. The RSI at 61 is still in bullish territory, but the MACD is flashing bearish momentum. The 20-day moving average is $203, and the 50-day is $139. That gap is a momentum chasm. The fund is priced for perfection, but the macro narrative is selling you tariff terror. Trump's trade war headlines are everywhere, yet SOXL's top holdings, NVIDIA, Broadcom, AMD, derive 30 to 40% of revenue from China. The fund's narrative ignores that structural risk. The lab doesn't. Here's the PR decode. Direxion is selling you a leveraged bet on semiconductors, but the real story is hardware commoditization. Spiking neural networks and on-device generative AI are shifting the compute stack from cloud GPUs to edge memristors. SOXL's legacy GPU-heavy portfolio isn't engineered for that transition. The premium is retail chasing yesterday's narrative while the hardware future is being built on silicon they don't own. SOXL is a momentum trade, not a semiconductor play. The premium is the exit tax you'll pay when the narrative flips. Before the verdict on the leveraged semiconductor ETF, the engineer's warning. 3 times daily does not mean 3 times monthly. A 10% up day followed by 10% down leaves the base index at -1%, but the leveraged semiconductor ETF at -9. That's volatility decay. Short-term tactical only. Know your exit before you enter. The CNN Fear and Greed Index currently sits at 8, signaling extreme fear that historically precedes a massive capitulation bounce. The lab views SOXL as a triple-leveraged engineering manifold for the AI gold rush. With NVIDIA and TSMC commanding 24.6% of the NAV, this fund bets on the most critical supply chain nodes. The structural bull case rests on the CHIPS Act and the insatiable corporate demand for AI infrastructure. Chipmakers are selling the only high-quality shovels in a global market with no viable alternatives. However, The bear case is a physical reality, not a sentiment shift. Any manufacturing disruption in Taiwan or a sudden contraction in data center capital expenditures will trigger a violent deleveraging event. We are tracking MACD bearish momentum even as the fund maintains a year-to-date gain of 43,000%. This extreme divergence creates a high-tension technical setup for institutional players. If price action breaks above the $222.01 resistance, then institutional momentum will chase. If price breaks the $200.87 support floor, then extreme fear will trigger a liquidation. The lab assigns SOXL an AI ETF score of 67 out of 100. At these levels, the rational play is to wait for the support floor to hold before adding exposure. We must see capitulation volume before committing capital to this leveraged instrument. High-conviction hardware cycles require disciplined entry points. Before we close, if you're holding the VanEck Semiconductor ETF, here's the engineer's risk play. Paired at 70-30 with SCHD, you keep the sector upside while the dividend side, currently yielding 325%, compounds through every correction. That's not diversification for its own sake. That's a barbell. Max upside on one end, cash flow floor on the other. The lab runs this structure. Now you know why. SMH's 200-day moving average just flipped bullish. This isn't noise, it's a structural breakout. Bulls or bears winning SMH this week? Drop your prediction below. This isn't financial advice. We're engineers, not brokers. Markets move fast, data gets stale, and past performance never guarantees future returns. Always run your own numbers and trade your own plan. The lab's signing off. See you in the next deep dive.